Welcome back, Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Bob Hoye with me once again. It's been quite a while since Bob was last on the show, so let me just give you a little bit of a background on him, and maybe quite a few of you who are not familiar with him. He has a degree years ago in geophysics, and he worked as a young man for various junior exploration companies and during the summers. And then I guess he spent one winter in the bush, and he said, that's enough of that, and he decided to do something different. Then he went into the financial markets and started, he was on the trading desk and in research, did research in a department with a large investment dealer in Canada. Bob's review of financial history provided the forecasting models that he's found very useful and has used over the years. He looks at significant trend reversals during periods of alarming volatility, typically during the transition from rampant speculation in tangible assets to fabulous speculation in financial assets as well. And, of course, the other side of it is that dreadful post-bubble contraction that some people have had just a tiny taste of, it seems, but some people think that there's a lot further to go. We'll get Bob's view on that in a moment, I'm sure. So he combines technical work along with economic analysis. He's a great student of history and looks at the big picture as well as shorter term moves. But I've known Bob over the years as one who looks at the big long term what's happening in various markets. And those periods of transition are very important because most people don't catch them. I think we tend to think that what we've experienced in recent years is going to continue forever, but that's why it's important to study history to learn that that's not true. Bob writes a weekly overview of pivotal events, which is just now calling for a multi-year bull market in the gold sector. So, Bob, I'm really happy to have you. Thanks for joining me. We want some good news for a change.
Yeah, Jay, thanks a lot. Yeah, I'm going to say right off the top here that a great financial bubble changes the world on the way up because people discover, hey, this is the way to get rich, and then it reverses and goes down. But it has an influence on gold and gold stocks, see, because there have been each of these great financial bubbles, of which the latest is number 6. The first was the South Sea Bubble in 1720. And I found decades ago that there were common features in each one. And one of them is the real price of gold in the senior currency. And for 100 years or more, England was on a gold standard. So you think the price of gold is fixed. But then when you deflate it by the CPI, you find that, hey, it does things. And what it does in the final stages of a great financial bubble is that the gold real price goes down. Mm-hmm. And it did. And the latest posting is always, of course, a month or so behind because you're dealing with the U.S. CPI. And it is still going down. And the reason we follow the real price is that it reflects profitability of gold mining. And I'm going to take a jump here, Jay, that people can readily understand, is that between mining and running a mine and the mill takes a lot of energy, and that relates to crude oil prices, and then blasting agents and all that sort of stuff. So maybe 50, 60% of the cost of mining is energy. And if you've got crude oil falling relative to gold, that side begins to look a little better. So this is where we did it. Now, the gold's real price is still going down. But if you take a look, and we did this in June, took a look at gold divided by commodities, specifically the CRB. Now, in June, July, it was bottoming. It was generating all kinds of downside capitulations and selling pressures and all that sort of stuff. So, looked at previous lows in that, let's call it an indicator, and they had a tendency to lead the next rally in the sector by up to 4 months, which then counted out to around October. So this is what, since last summer, we were thinking there was a probability that the downward pressures on the gold sector would continue into October.
Mm-hmm.
But and they have. So and then the latest update on gold divided by commodities, it's in a pattern we really like, where you get an oversold, which was June, July, and then you get stability, base building. And we found this in the past. That can run for around 5 months. And then when you got whatever you're watching, it starts to rise above the 20-week exponential moving average. That concludes the base successfully. And, for example, we used this in the first half of 2021 on the U.S. dollar index, the DX, and that worked out well. And then we've also used it, I think, at the same time on the gold-silver ratio, and it was bottoming, so that was good. So the issue is that the profitability of mining depends upon the spread between bullion price and their costs. Mm-hmm. But now it's only in the last few months that I realized that the standard method of looking at gold stocks is to look at the U.S. dollar, condemn the Federal Reserve, which I join, and say that the U.S. dollar is going to crash and gold's going to go to 10,000. But that hasn't been working lately. Mm-hmm. But what you then if you're buying gold stocks on the prospect of the U.S. dollar going down, you're effectively speculating in foreign exchange markets. Mm-hmm. But if you look at our way, where you look at the real price relative to CPI or relative to commodities, then you're looking forward to an increasing stream of earnings. Mm-hmm. And when you're buying an increasing stream of earnings, you're investing in that industry. Mm-hmm. Now, with this, as I said, with gold's real price going down in each bubble and then going up, you've had copper do the opposite, and back to 1825. And copper's real price, as deflated, goes up in the final year or so of a great financial mania, and then it turns down. So this is where, in such a boom, you make money on the base metal miners, and you're going to underperform with the gold. So there's no point being in golds through the final stage of the bubble. And then the irony, Jay, comes in when you get the financial pressures that really end the bubble, which has been on. Then it hits the gold stocks. So we've seen in the last couple of months a washout in price on the main gold stock indexes. Mm-hmm. And also, as you know, the whole junior exploration side took a hit that I haven't seen one of those in ages. So the sector is really, really crapped out. Now, what I want to do is look ahead to when and we're using gold divided by commodities, when it finally pops up. Now, for the last few weeks, we have suggested to our subscribers to begin quietly accumulating gold stocks. That would be from seniors to juniors, but not to get fully positioned until a few of our indicators come into place, like when we conclude the successful base in gold divided by commodities. Mm-hmm. Now, I want to take the next step, which is one can see how readily for mining, if you've got a lid on costs and the bullion price is doing okay, then you're making money. But that's for producers. But just the fact of the real price going up also enhances the valuation of a prospect in the field. If you've got a good-looking mineral deposit and the value, or the relative value of it's going up as the price of gold, real price of gold goes up, it enhances the exploration side. So So this is the foundation of our long-term thing here. So what we are, we thought that maybe the bottom could be around October, and it's getting stretched out, and we've got an indicator that will, when it turns up, we will get more aggressive. Now, here's the thing, the next thing we want to look at is that previous post-bubble contractions after 1929 or after 1873, 1825 was another one. One of the features was a long period of weak commodities, weak wholesale prices, weak purchasing or power for earnings for ordinary companies and industry and stuff like that. But with the real price of gold going up, you go into then a long bull market for the sector with, who knows, previous post-bubble contractions have lasted for 20 years in that order. But the usual 3 to 4 year business cycle keeps coming and going, and it continues. So with some cyclical interruptions, the bull market in gold's real price is multi-year. But you also have to have, the golds won't go up when the S&P is crashing. But once it stabilizes, and then it starts to go. So here's the other thing about let's talk about the GDXJ as being representative. So once it gets in its uptrend, it's not just going up, but it'd be likely outperforming the S&P. And for all the years I spent in the institutional side of the street, I know that equity fund managers, they may be running a portfolio that doesn't include gold stocks. But you have 2 quarters with the GDXJ outperforming the S&P. There's going to be many fund managers who say, hey, I got to get aboard. So that then, of course, that's ahead from whenever it really starts to head up. So this points out that our outlook, once bottomed and turned, is extremely bullish for the sector. And from time to time, it'll be really hot. And then also from time to time, there'll be major discoveries. They happen. Now, we're going to back up a bit. It's like go back to 1929, and Homestake was the premier producer then and was producing gold at a pretty well constant rate. And, of course, their stock got hit with the crash, and then its stock stabilized around $9 in 1930, 31, and you could accumulate the stock at that level. So what I did was took it to the end of 1932 because Roosevelt didn't start messing around with gold until March of 1933. So by the time you got to the end of 1932, the S&P had been trashed, of course, but Homestake stock was up something like 130% from the $9 level, and their earnings were up about that as well, but the price of gold was still $20.67 an ounce. But the reason why the gold sector was making money was because their cost of operations reduced with base metal mining and smelting operations being shut down. There were miners available, there was equipment available, so their supplies were cheap, and the gold sector was making money, and it continued. So take it further, then in 1933 is when Roosevelt was fooling around with the price of gold. They thought by raising the price of gold in U.S. dollars that it would help commodity prices, and that would help farmers. That wasn't working. So then what they did was enhance what was going on, which was the real price going up. So then that really put the real price further up. And Homestake eventually in the mid-1930s was trading at $65 a share from your $9 accumulation. And then also, Jay, get this, that in those days, gold miners paid out virtually everything by way of dividend.
Yep.
So through the mid-1930s, on your $9 purchase, you're getting $4.50 a share annually dividend.
Well, Bob, it took a depression. It took a great depression. We've some people have said we've got the bubble, the mother of all bubbles here.
Yeah.
Do you think I don't say this cheerfully by any means, but do you think we could be seeing something akin to something really dramatic on the downside that's hard to envision right now? Of course, most people think that governments are here now to fix everything, and they weren't there in the 30s. And we had the gold standard, which they blamed for the depression, which of course is a lie.
Yeah.
But that's what people think. That's the propaganda. But what are your thoughts? Is it going to? Are we in for something very significant on the downside? Because I looked at this morning, I think that the S&P is only down about 18%.
Yeah.
From the start of this year. This not much of anything has hit us yet.
Yeah.
And yet, when you look at all the things going on in the world, you'd think that maybe we're in for something more difficult.
Well, you've got the intrusions by crazed governments was so that they had the lockdown within the midst of a bubble, and that then put a hole in the economy. And then maybe the strong, relatively better GDP number for the third quarter, maybe some of that, I know some guys are saying it was inventories and screwing around and stuff, but maybe it also was helped by folks just sort of getting back to normal.
Right.
Okay, now every post-bubble contraction has been severe. It's like it's a change your world on the way up where everybody becomes prosperous for a while, and then it's a change your world on the way down. Now, in 1929, the S&P and the Dow, they fell to the low in July 1932, was sort of 85 or 87%. Now, at that time, the New York market was junior relative to London. And the speculation was wild, and that was the crash. Now, in London, their representative stock index fell in half. Bad enough, eh?
Yeah.
So the post-bubble contractions are change-your-world stuff. You have chronic pricing pressures in most commodities, and let's say wholesale prices, and industry and commerce has a tough time with pricing, and so you have and then you have a problem with companies servicing debt, and you have even junk bonds being going no bid in default, and then you have many investment grade bonds going to junk and then to default. So it's just plain ugly.
Yeah.
But through it is the feature of gold. So one would wonder why, in a post-bubble contraction, the price going up. Now, what does it do? Well, it makes the business whole more prosperous. So gold production numbers go up. And they can go up hugely. And where does the gold go? Well, it goes into the financial system, and it starts to restore liquidity in the banking, where the previous liquidity of all kinds of debt instruments had gone zero, went around. So Mother Nature has a plan for gold, and all of the economists out there, interventionist economists and interventionist central bankers hate gold. But the rise in gold and the increase in production will begin to restore liquidity in a blitzed out banking system, and it's happened every time. As a matter of fact, Jay, there's amazing numbers on 4 out of the 5 major contractions in England in sterling, and that was the senior currency. The rise in the real price of gold on the lengthy, like the 20-year, was 1.7 times. And it did it 3 times.
Yeah. Bob, we're
So
just
this
about
is
out of time here. We're just about out of time here already. There's so much more to ask you. I've hardly asked any questions, but I want to ask you. I want people to know. So essentially, I think on commodities, you use the CRB, and how do people know? I mean, they can subscribe to your letter and tell them how they can do that.
Oh, yeah.
Because
it's just bobhoye.com, chartsandmarkets.com. There's a couple of ways of getting in. And for the fun of being back with you, Jay, we're offering a 25% discount on new subscribers.
Okay.
And we've also put together a list of small cap gold stocks that we like. They range from producers, next to producers, and some exploration stocks in there. I think there's about a dozen. We monitor them technically as well.
Okay.
So folks should get in touch. The research has been reliable, and we're always delighted to talk with people. And then, as I say, we've got our list of small cap stocks that we're looking after. I mean, we're running the technicals on each one.
All right. Bob, I want to ask you just one real quickly now. You must think that oil is going to be coming down if you're bullish on the real price of gold. That's one thing. And the second thing is, and we just with less than a minute left, how do you know when we're at the top, the other end, when gold gets overvalued and we better start to exit? What do you look at? Do you look at that silver-gold ratio sometimes?
That one's been reliable. The silver-gold ratio. When the weekly RSI, relative momentum thing, gets up to 90, then that's a sell on the sector. And the last time it got to there was April 2011 on that fabulous speculation in the sector. And the only other time it got that high was in January of 1980 when that silver cartel went crazy and then crashed. So we will have, and then all here on the exploration side, Jay, you'll know the top is when some young promoters who don't know a clue about anything start promoting that property in Nevada that has so many holes drilled in it that when the wind blows, it whistles.
Okay. All right, we'll have to leave it go at that, Bob.
Okay,
we're out of time. It's really good having you again. We'll look to have you back again and keep us updated on where you think we're at in this gold market right now.
Okay. Keep you posted, Jay.